So welcome everyone to our closing session, unfortunately, of the 2020 McGill Tax Policy Colloquium, which has been an extremely productive and diverse event, bringing so many different perspectives from all over the world on the main topics of discussion tax policy today. To end this colloquium with the highest note, we have the pleasure to have with us today Professor Dr. Afton Titus. And today she will enlighten us with a lecture on two of the hottest topics at the moment and their connections, automation and COVID-19. So if Professor Afton is ready, the floor is yours.
Great. So today I will be presenting on the design of an African tax policy for the future, where I will set out the synergies that I see between COVID-19 and automation. So in my paper, I argue that the COVID-19 tax policies could be adapted to harness the potential of widespread automation in business. When I do this, I focus particularly on African countries because the continent has been particularly hard hit economically by the pandemic. So in doing this, I thought that it may be more useful for you if I were to set out what my thinking was in setting out this paper. To begin with, I will take you through a very brief background before I set out the automation tax policies that informs my analysis of the COVID-19 tax policies. I will then set out what synergies I see between these two events and how they speak to each other before I set out my recommendations that are specifically tailored towards African countries. So the COVID-19 pandemic has had a devastating impact on economies, and that's not even to mention the heartbreaking health statistics. So many people lost their jobs, many businesses were forced to close. In a bid to stop the devastating impact on the economy, governments introduced emergency tax relief measures in a bid to keep economies afloat. It's only recently that the attention has turned towards the long-term impact of the pandemic and what would be required from a tax policy perspective in order to sustain economies and also governments. Now, early on in the pandemic, it became very clear very quickly that there was a link between the reality of COVID-19 and the usefulness of automation. So automation was the answer to implementing the health protocols that were necessary to stop the spread of the virus. Lockdowns had forced many businesses to transact on online platforms, and the closing of borders forced many international companies to actually house their supply chains domestically. Now, the linkages between COVID-19 and automation have been discussed before, and this is not a new topic. This paper builds on these discussions and adds an analysis of the tax policies that may speak across the devastation of the pandemic and towards the promise of automation. So when I started looking at this area, I was actually working on a different paper. I was working on a paper about the promise automation holds for African development in general. And in evaluating the literature in this area, I realized that a lot of this discussion focused on these projected fears of what automation would mean for Africa. So these fears may be grouped into the following three categories. The first is that there would be mass unemployment because the robots would all come to Africa and take over every single job, that there would be a critical lack of skills because Africa simply does not have the capacity to deal with automation or to harness its potential, and third, that there would be rampant cyber threats to such a degree that it would completely overwhelm African countries and their attempts to have any sort of cybersecurity put in place. So as I delved deeper into this research, I discovered that these fears were quite misplaced. So first, when it comes to this issue of mass unemployment, it's not at all clear that that would be the impact of widespread automation in business. In fact, there are many studies that indicate that what is likely to happen is that as one job is lost, another will be replaced. In terms of the critical lack of skills, Africa is working really hard to build the necessary capacity to meet the challenges of an automated future. So programs such as formal education programs are currently in the works all across Africa, together with infrastructural development projects, which aim to bring internet access to more Africans. Then in terms of cybersecurity, African countries are taking this seriously. So for instance, Botswana, Cameroon, the Ivory Coast, Ghana, Mauritius, Nigeria, Senegal, Tanzania, Uganda, and Zambia all have specific legislation which deals with cybercrime and electronic evidence. So there's significant movement in place to make sure that Africa is prepared to meet the possibility of more automation being used in businesses. Now, as Africa moves forward with its development, of course, the question is raised, how is all of this going to be funded? So when I looked at this literature, I came across these three prospects for revenue raising, which are decidedly uninspiring. So the first is that there would be a tax on robots, that we could alternatively rely on digital taxes, and then finally that we would encourage automation and increase productivity through allowing capital allowances. So first, when we look at this idea of taxing robots, what the proposals here say is that you could first have a tax based on your sales to employee ratio. So the idea here is if your number of employees on the floor is low, that would mean that you are likely using automation by which to drive up your sales. So the idea then is that the higher the ratio, the higher the tax. The second proposal is instead that we should give robots legal personality and that we would tax a notional income attributed to those robots. So this income would be calculated based on the amount that a human would have earned had that human been carrying out those particular tasks. Now, at this stage, you may be wondering, why would you need a separate tax to address the challenges of automation? So the arguments for this are essentially that there should be a direct replacement effect, that if you are going to have a shrinking labor income base, then you should replace that directly with a robot income base. And furthermore, if you fail to do this, there will be rampant inequality because wages will fall as you use more automation. But these arguments are flawed because they fail to take into account the many studies that have proven that once firms use automation, it boosts their productivity and it also boosts their market share. So with an increased market share, there is a greater opportunity for employment to be created as firms are expanded. There is no clear evidence that automation will in fact lead to mass unemployment. Then there's also no evidence that income inequality will result from increased automation. In fact, the evidence seems to suggest the opposite, that as workers are displaced from one job, they are reskilled into a different job, and in so doing, they end up earning higher incomes than they had before. When it comes to this concept of digital taxes, this concept arose primarily because of international discontent with the inadequate taxation of the frightful five. So this resulted in the rationale that there should be a targeted approach towards the identification and the taxation of the profits of the companies that sell digital services or are otherwise engaged in e-commerce trade. So in this area, there have been international initiatives, mainly led by the OECD, in which they try to provide mechanisms by which to identify that particular profit and then subject it to tax in a particular jurisdiction. Over and above this, you also have unilateral tax measures by individual countries as they try to attribute part of those profits generated from these digital companies, and they try to attribute it to their own particular jurisdiction. Now, African countries have also used digital taxes. They also have their own version of this. As you can see from this table, countries like Benin, Mozambique, Tanzania, Uganda, and Zambia have all introduced a form of digital taxes. But when you look at this more closely, you will note that while the rest of the world is attempting to capture the profits of these big giant digital companies, African countries have gone a different way. They've chosen to tax the consumer of the digital service. Now, the effect of a digital tax that could be in the form of this or any other digital tax used by a different country, and also the effect of a tax on robots, effectively it results in a cooling effect in that people would be deterred from actually using automation, which is something that is not desirable. Also, my sense is that a digital tax and a tax on robots is far too focused on taxing income, and not enough focus is placed on the taxation of capital, which of course robots and automation and digital technologies are ultimately capital. One tax policy that does not have this particular focus is the idea that you should provide increased capital allowances to businesses, and this is in a bid to encourage investment in automation. So the idea then is that you would want companies to use automation to become more productive, and ultimately they would create more taxable income, because if they are able to produce more, they are able to sell more, and ultimately they are able to earn more. So after this very uninspiring list of potential mechanisms by which to raise the necessary revenues to sort of address the challenges of automation, I thought to myself, there has to be more than this. And that is the frame of mind that I brought to my analysis of the COVID-19 tax policies that have been implemented across the world. Now, countries everywhere have almost uniformly introduced the same tax measures to address the challenges of the pandemic. So in terms of the initial tax policy responses, globally, we've seen that there are tax measures to boost cash flow for taxpayers, and that you could see, for example, in the provisions that would defer the payment of corporate income tax, or even the payment of VAT. You would see tax measures to reduce the barriers to the provision of medical equipment. And we've seen some tax measures to create greater legal certainty, especially in respect of issues arising from prolonged lockdowns in some countries. What is particularly interesting also is that African countries have mainly followed the same formula. So African countries have introduced tax administration responses such as flexible payment plans, extension of deadlines, and accelerated tax refunds. And they've implemented tax policy responses such as lower tax rates and increased deductions and capital allowances. What is interesting to me is the long-term COVID tax policies that have been proposed so as to sustain governments and economies. And these are that there should be a wealth tax, there could be a solidarity tax, you should rely more on carbon taxes, or you could introduce an excess profit tax, or sometimes it's called a windfall profits tax. This is interesting to me because I wanted to see how these could be adapted in an African context to meet the challenges of encouraging widespread automation in businesses. So let's look at each of these in turn. Start with a wealth tax. Now, a wealth tax could be a once-off tax, or it could be a tax imposed on a continuous basis. So the base would be the worldwide net assets of a particular taxpayer with a connection to his jurisdiction, or otherwise the assets that happen to be situated within that jurisdiction. Now, typically, African countries have some form of a wealth tax, and that's usually in the form of a tax on the transfer of assets. I struggled to find a net wealth tax in Africa. So a net wealth tax is a tax that is imposed on the difference between the sum of all of the taxpayers' wealth and all of the taxpayers' liability. So this is not a particular popular tax, and not very many countries across the world have it. And the number who do have it is actually dwindling. Now, from an automation tax policy perspective, and as greater automation is used in business, a wealth tax may be feasible for African countries. I say this because this tax has the potential to identify and then tax the wealth that an increase in capital assets actually represents. So it holds some promise for African countries. The next proposal under the COVID-19 tax policies is that countries should consider imposing a solidarity tax. So this would be a temporary tax, and the basis or the reason for this particular tax would be so that there would be greater funds available to fund the government's social welfare spending. So this tax would be imposed on the taxpayers who were unaffected or otherwise enriched economically by the pandemic. And a tax like this would be imposed either on the income of the particular taxpayer or on the assets. Just generally, in a COVID-19 pandemic situation, and considering whether a solidarity tax would be useful in Africa, we do have to consider the particular context within which African taxpayers are situated. So often what happens in Africa is that you would have a particular individual who was fortunate enough to earn their full salary throughout the pandemic, but at the same time, they have a moral obligation to financially assist family members or even friends who were not as financially secure. So this is colloquially known as black tax. So in such a circumstance, if you were to impose a solidarity tax on income, it seems unfair to place an additional burden on these individuals. So in circumstances such as these, it would probably be best if you had a solidarity tax imposed on assets rather than income. Now, from an automation tax policy perspective, would a solidarity tax work in Africa? I consider that it could be a possibility, but it would certainly be a once-off tax, and it would usually, and it should be a tax of last resort. I say this because this tax has the potential to deter people from actually using automation, and it's something that you don't want. So the way that I see a solidarity tax working is that you would have this once-off tax imposed with the idea that the funds raised through this tax would be used to encourage and subsidize certain businesses from using automation, to encourage them to use automation, either because they haven't used it at all or they're not using it efficiently enough. And this tax would then have to be imposed on those businesses that have successfully integrated automation into their businesses. But like I said, this would have to be a once-off tax because you don't want it to actually deter people from using automation in the first place. So the next proposal under the COVID-19 tax policies is that there should be a broader use of carbon taxes, that this remains a viable source of raising revenue. And of course, it has the side effect that it is extremely good for the environment for people to think about their carbon footprint. Now, in Africa, only South Africa and the Ivory Coast have carbon taxes at the moment. So it represents a growth point for African countries. Would a tax like this be useful when we think about the tax policies designed to encourage automation? Yes, it would. So if you have environmental taxes along with your other measures and other taxes meant to encourage automation, what you would have is you would force taxpayers to use their choices around which technologies they use, and they would use this wisely, considering what the effect on the environment would be. And you would have this influence behavior occurring even as this particular tax would be raising revenues, which is a very good thing. So the next proposal is that we should consider imposing an excess profits tax during the time of the pandemic in order to raise further revenues. Now, the idea with this is that you would have surplus profits made by a particular taxpayer during the pandemic, And that surplus would be subject to a further tax over and above the corporate income tax or the personal income tax that is already being paid. The idea of an excess profits tax is not a new idea, and we have seen it before, but it's typically used in war times. Now, this is particularly intriguing for Africa because some African countries have actually used an excess profits tax before. For example, South Africa had an excess profits tax in 1917 with respect to World War I, and then again in 1940 with respect to World War II. What is particularly interesting today is that the Democratic Republic of Congo has used an interesting twist on this excess profits tax. So they imposed last year a super profits tax on mining companies, which of course is interesting because it is operating outside of war times. Now, would this tax have any potential when we think about its application in the automation sphere? And yes, it would. An excess profits tax would have potential in Africa because many African countries are familiar with this concept. So in that respect, much of the heavy lifting has already been done. You already have legislation which details how the tax is to be defined, how the tax is to be calculated. And so it would be a small step to take that legislation and rejuvenate it with the idea that you could use it to identify and subject to tax the profits of digital companies. So this does hold some promise for African countries. So through this discussion, I've identified some synergies between the events and the tax policies around COVID-19 and the encouraging of automation. So first, the initial COVID-19 tax policy responses would be well suited to incentivizing automation. For example, the provisions that would provide tax relief for employees, a waiver or a deferral of their tax payments would be very welcome for employees who were, for example, displaced by automation and then had to reskill themselves before finding another job. Also, the projected fears of what automation would mean for Africa is being played out in real life in the pandemic. So at the moment, African countries are having to deal with mass unemployment, they're having to deal with a critical lack of skills, and also with an increased cyber threats. So at the moment, African countries are actually learning how to address the worst possible projected outcomes of a widespread automation in businesses in Africa. And then the long-term COVID-19 tax policies hold much promise in how they may be applied to encourage automation. So these policies are interesting because they offer a broad spectrum of taxation in that they offer the opportunity to tax income and the opportunity to tax capital. Over and above that, they offer the opportunity to limit and then account for the impact that automation may actually have on the environment. So these policies do hold a great deal of promise for African countries. So in my paper, I set out a number of recommendations for African countries that would aid their development towards greater automation. So in terms of government spending, I advocate that the funding should go towards education, that there should be funding towards internet infrastructure and security, and that there definitely should be measures put in place to help transition employees as they are displaced from one particular job and then reskilled into another. From a government revenue raising perspective, I argue that the wealth tax and an excess profits tax and a carbon tax holds great promise for African countries in its potential to raise revenues. A solidarity tax is a potential mechanism by which to do the same, but it should only be used as a last resort because of its potential to deter the use of automation. And then the good old faithful idea that you should have increased capital allowances so as to encourage investment, that is also a good tax policy to keep in place. So what is next after this? What I plan to do with this particular draft is I'm going to flesh it out with some of the newer ideas I've thought about as I was preparing for this particular presentation. I'm also planning to build on this research by making recommendations for specific African countries and specific regional blocks. And in doing this, I plan to flesh out each proposed tax and analyze its viabilities for specific African countries or regional blocks. Thank you. That's my presentation.
Thank you very much, Afton. This is amazing that we got to have you as our last speaker, especially because you addressed a topic that it's so new and it's so interesting, and you addressed it in a very in a way that I personally like very much, which is first you addressed it from a fiscal policy perspective, not just a tax policy perspective. So you're talking about tax, not only raising money, but also how you spend the money. So this is very interesting. You have a clear thesis in your paper, and it is something that I also enjoyed in reading, the fact that you try to make connections between COVID and automation and try to show that they're not that different. And also with the solutions that we're talking about. So when you discuss the tax on robots, you question whether we need a new tax and why can we do it with the tax that we already have. And that's something that I also appreciate. So we're gonna go for the questions, but before let's end this colloquium with a big round of applause for this amazing presentation. So